Hi there copiers, it is Monday the 6th of December and that means it is time to look at what moved the markets last week. Starting with stats, so my portfolio's had a pretty shitty few weeks compared to the S&P 500. The S&P 500 also had not the greatest time in the world, but my portfolio's been more hard hit. I'll talk about why in a moment and why this doesn't worry me too much. There are quite a few measures of the amount of fear in the market at the moment, and one of them is the 1 month call put skew. So there are a huge portion of people that have been hedging their portfolios, and the contrarian point of view is that when hedging is at its strongest, that's usually the time when the market is looking to turn. The thing that I like about this measure and this particular chart is that it shows historically how often that has happened. There are a few times when it's spiked below, but that spike below doesn't last for very long before changing direction. Looking a bit more in depth at the various ETFs, but also indexes that represent the markets that I look at. So starting in early October-ish, we saw a nice rally across a large number of these. So just very quickly, we've got the NASDAQ 100, S&P 500, IWO is the growth portion of the Russell 2000. Yellow is the Russell 2000, so those are 2000 small cap stocks in the US. And VWO is an emerging markets ETF. So what you will notice here is that a lot of them were rallying quite nicely for about a month from early October to early November, and then things changed. Things started getting choppy, unless you were a smaller company, in which case the only direction was down from that point onwards. Now, while I hold a few very large companies by market cap in my portfolio, Amazon, for example, is a mega cap, definitely. I don't hold a lot of those types of very large businesses. In fact, a large number of my companies, they might be mid-cap or just below mid-cap types of businesses. And so my portfolio has tended to track the correction that has been happening through many, many weeks. I think nearly 6 or 7 weeks now in the likes of IWM. Just to get a perspective across the wider market in terms of assets, so cryptos, as you probably will have noticed, have also been not having the most fantastic time. There are a few bright spots in the crypto landscape, but they are few and far between. Bitcoin dropped pretty significantly through the weekend, but has rebounded. And so it seems that cryptos are quite closely correlated with risk assets, such as equities. Again, continuing the theme of looking at all of the different performing assets through the market, commodities haven't had the best week or even month either. I did mention a while ago that natural gas was likely to come down quite strongly from the highs that we saw. Lumber is one of the few that has held up quite well. I'm not sure exactly what's going on there. I'm wondering if it's something to do with home building, but things like oil, etc. have also dropped off of a cliff. Yields on the US 10-year Treasury have been dropping. They dropped quite significantly from their highs. I think it was a 20% drop at its deepest last week. And this tells us that people are buying bonds en masse. US Treasury bonds are seen as a safe haven. And this becomes another measure of the amount of fear in the market. People are rushing to buy bonds. Bond prices go up because there's more demand, which means yields, which have an inverse relationship with bond prices, go in the other direction. I don't have a chart up, but also the US dollar has been increased in value for a while yet. I'm not sure how many of you follow Ben Laidler's updates. He is a fantastic analyst and strategist from eToro. I love his posts. And a bit of a bright spot in all of the negative news that was coming out last week, and the negative consequences in prices of various assets, is that the pain that has been experienced in supply chains seems to be easing off just a little bit. There's still a fair amount of pain in there, but things are starting to look better. And this means that shipping prices, for example, are starting to get a little better too. There are various indexes and ETFs that you can use to look at the cost of shipping around the globe. They measure it in different ways, or they measure the cost of shipping different things. The Baltic Exchange Dry Index is one, the Shanghai Container Freight Index is another, both of which have seen a bit of reprieve in recent weeks. So what the hell is going on to cause this huge amount of selling across the board? In some places, the selling's been going on for longer. In other places, it only started about 2 weeks ago. So if you cast your mind all the way back to 2 to 3 weeks ago, you will remember that coronavirus cases within Europe were on the rise. People were starting to get scared. about lockdowns. In fact, lockdowns were beginning to kick off in parts of Europe. Then we also had Omicron landing, probably coming from somewhere in Southern Africa, or at least being first detected in Southern Africa. But as I have said in a number of posts and videos, I think that this is part of the cause of the selling, but not the primary trigger. In fact, I think that QE tapering is probably the thing that's been driving this the most. Concerns about less liquidity in the system, the cost of credit for smaller companies and riskier assets. Of course, the delisting of DIDI from American stock exchanges really hammered Chinese equities. Bloomberg put out a few posts saying that the Chinese government was reviewing the process by which Chinese companies list in the US, and this stoked many different kinds of fears. And Chinese stocks, for the 17,000th time this year, took a bit of a hammering, taking that part of the market down with them. However, I do think that there's one other important aspect, one other consideration that I'm not seeing much about across the market, and this is something called tax loss harvesting. Now, this process happens in all countries around the world, but it depends on the legislation of your particular country. In this case, in the US, it seems as though people with a lot of money in the markets who have positions that are deep in the red are potentially closing out those positions so that they can offset any gains they have somewhere else in their portfolio against the losses of those particular positions. In summary, it's a way to reduce your capital gains tax bill by selling those stocks in your portfolio that haven't performed very well recently. There are a few stocks where I think this might be happening, and others think it might be happening too. An example would be PayPal. Now, imagine you had bought PayPal somewhere in the last year on the way up, and it had risen to a fantastic high level, and recently it's been dropping off quite sharply. They had a bit of a miss on earnings, still a very strong company, and this meant that your position was underwater. You were in the negative for this particular position. You could then take this loss, let's say at minus 10%, and you might be able to offset it at against another position that you had closed at plus 10% if they were for the same amount, and this would massively reduce your tax bill. We're at the point in the year when US investors tend to do this type of thing, and it would in part explain why the sell-off has become more aggressive in some companies that are fantastic businesses that have sold off a little bit. You can see that, for example, in PayPal, the drop has been precipitous in recent weeks. It doesn't really make a lot of sense. And of course, fear breeds fear. So the strongest catalyst for selling is selling. And there are lots of investors in the market at the moment. A lot of retail investors have come to the market in the past 2 years. They don't have a lot of experience of large drawdowns or huge market volatility. And so when these things happen, they get shaken out of the market. And when they get shaken out of the market, other people, seeing that they've been selling, think that they must be onto something, and they get afraid and they sell out of the market too. All right, so we've looked at what happened, why it happened. Now what? What does this all mean? Well, unfortunately, we're still a little short on details around Omicron. I follow a few different scientists and also publications that summarize the data, the findings of scientists in manageable, at least manageable for me, kind of forms. So this particular Twitter thread is from a journalist that works particularly in this area on the ground in South Africa. And the findings out of the hospitals are quite good. But in reality, and I like her honesty, she's saying we need more data. The Omicron variant just hasn't been around for long enough for us to know the long-term impact on humans that it has, as well as the impact that it has on our vaccines. But it's looking pretty good. The thing to be wary of is that South Africa is quite different from Northern Hemisphere, lots of Northern Hemisphere countries. The population is quite young. The average age of South Africans, I think, is 24, 25 years old. And also it's quite a hot, sunny country, and sun does a lot to kill the virus, but it also means if it's nice and sunny, people are going to be outdoors a lot more. What else? What else does this mean? Well, the Santa rally, which I'd been expecting, because statistically it does happen, is at risk. So there's an Investopedia article that's quite good in breaking down the various different bits and pieces of the statistics. It talks about the Santa rally and how December is traditionally the best month for S&P 500 index gains, but January is not too bad either. Now, if you were to find out that Omicron was mediumly bad or not bad at all, I think that the markets would take this quite well, and the Santa rally might just be delayed. Remember that a lot of companies, we've just been through an earnings season where lots of companies have showcased incredible earnings. I think January will not be too different for certain types of businesses. And this is when those companies will start reporting, January, February kind of timescale. So everyone is going on holiday. Things are starting to slow down around the world in anticipation of Christmas. But people come back to their desks in early January. And this means that we tend to see a lot more volume in that month. So once again, it depends on Omicron to some degree. But I reckon that we're going to see another very good earnings season in Q1 2022. And a lot of investors know that they're not going to want to be out of certain positions ahead of earnings early next year. We're also starting to see a bit of a change in tune. The Bank of England is looking unlikely to raise interest rates in this month, December. So it was thought that they were going to do it in November. That didn't happen. It was a huge surprise for the market. But it was an almost certainty that they were going to do it in December. But now it looks as though they're not going to do that because of Omicron. This is the course of action that some people had thought that the US Fed might take. If a virus variant is going to slow down growth, maybe the Fed might do things slowly in tightening up its economy. Whereas we now know that that's not the case, not yet at least. But that seems to be what is happening in the UK. I wonder if other governments might follow what the UK is doing. No one really likes to be the first, but they don't mind being second, third, fourth, etc. GDP growth might be slowing down, depending on Omicron. You guessed it. But even if it does slow down, global growth is still going to be very strong through next year. And this is a key difference from other times when the market has really tanked. So December 2018, ignoring 2020 for a moment because I've already spoken about it, but December 2018, the S&P 500 had a pretty decent pullback. Actually, it wasn't a pullback, it was a full-blown correction. However, the difference between then and now is, well, we have higher inflation, but also we have much stronger GDP growth. So while it hurts to have the types of pullbacks that we're currently experiencing, it does seem as though the backdrop is much stronger than those times when we saw bigger pullbacks like in 2018. And lastly, on the what does it all mean topic, I wanted to talk about opportunities. So whenever there is a pullback, correction, bear market, opportunities open up. Most people lose money in the stock market. And there are a number of reasons for this, but one of the reasons is that they sell when they should be buying. It's very easy to make this statement. It's very difficult to do the right thing when you're on the depths of a big chunky sell-off. Every major company that you know that's a massive success has seen huge, monumental drawdowns in their stock prices. Not for hours or days or even weeks. Sometimes they lasted months, maybe years. So if you wanted to make the fantastic gains looking backwards that you see in companies like Apple, Netflix, and Amazon, you would have had to wear some major paper losses for a decent portion of time before eventually reaping the rewards. I also wanted to touch on a sector that's been particularly oversold in my opinion. Software companies have experienced huge portion of the selling, and I think this is in part because a large number of the overbought companies were software companies throughout this year. Companies that have been trading at very high price to sales ratios with very little or no profitability whatsoever. And the market is selling these companies off, but it's also selling companies that it's lumping into the same category when they shouldn't really belong there. I have a few examples of the companies that are fantastic software businesses in my portfolio. One of the biggest opportunities I see right now is Digital Turbine. And they are a company that I think has come out of that speculative phase. They've grown out of that speculative phase through the past year and a half. Their stock price has increased enormously, but you can see that the revenue growth is insane and they are profitable. We have to watch them quite closely, but their margins are decent and hopefully they will continue growing those. I have been tracking this company for quite a while and I was kicking myself that I didn't get in earlier when the stock prices were all the way up around the 70s, 80s, 90s. And now the market has given me another opportunity. So thank you, market. Something else really interesting that has happened, and this was on Sunday, is that the China Securities Regulatory Commission put out an update on Sunday, so yesterday, following Bloomberg's article, bit of a smear campaign last week. This article is fantastic, and it hasn't made headlines as much as the Bloomberg article did, but what the Chinese regulator has said is that they are not going to make the current mechanism for Chinese companies listed in the US illegal. They're not looking to delist more companies from the US indices. And in fact, DIDI was a very special case. I'm not sure how many people know the background, but the Chinese government asked DIDI not to list in the first place, and they went against the regulators. And the regulators' concerns, I think, were valid. It's that Chinese company that's been asked to delist, and the regulators now saying, this is not a thing that we're looking to do wholesale. The Chinese company delisting risk has two sides to the coin, by the way. It's not just that China might delist companies, which we now know that they're not looking to do, but it's also that the US government might force Chinese companies to delist because there are auditing requirements that are coming up for Chinese companies. And in a single document, the Chinese government has also addressed the second risk, saying that they are working with the US to figure out how this auditing is going to work. Now, there will be people that say, we don't trust the Chinese regulator. Fine, I can't do anything about that. I have pared back some of my Chinese investments, but only because I think that coming out of this bear market in Chinese equities is going to take a few more months. So I will leave some of my positions in, and I will grow them as time goes on, as it becomes more evident that the party is returning to Chinese equities. So what about this week? We also got this piece of interesting news out of China, and this is the second time that China is going to cut the reserve requirement ratio for its banks. This is in order to speed up economic growth once again. For those that might not know, so a government, a central bank, can impose a restriction, a ratio on banks in terms of the amount of money that they need to keep in reserve. I'm simplifying this, by the way. So if you are a major bank in, for example, the UK, you might have to comply with a 10-to-1 reserve ratio, which means that for every £1 million that you want to lend out, you need to keep £100,000 on your books. So if the UK government were to increase the reserve requirement, that would mean less money sloshing around the system because the banks would need to pull some of that back in order to keep it on their books. And if they decrease the reserve requirement, then they can lend more money out. And because of the multiplication effect, which I'm not going to go into right now, that money that enters the system is multiplied many times as it makes its way around the economy. So through this year, the Chinese government has implemented about 10 years worth of regulation in 1 year, and they've tried to de-risk the economy in many different ways. This has had an impact on the growth of the economy, as well as supply chain issues and coronavirus. And now they're putting their foot on the pedal a little bit more just to make sure that the growth doesn't slow down too much. This week, we also get a few economic data points out of various economies. I think that Friday is probably going to be the most interesting day in terms of the impact this data might have with GDP data and core CPI inflation data coming out of the US. And just to finish on an optimistic note, every past decline looks like an opportunity, and every future decline looks like a risk. This is a quote from the author of a fantastic book, and it's entirely true. So if you had known about the decline in equities in March 2020, you probably would have sold everything you could to get money into the stock market. A once-in-a-decade opportunity, I think. However, we tend to treat those declines in the future like some enormous risk, when actually they are enormous opportunities that just haven't materialized yet. And so we are in the middle of one of these enormous opportunities. What are you going to do about it?